We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning. Treasuries facing pressure with yields hitting those 2024 highs as traders position for those U.S. inflation numbers. Markets now pricing in just 2 Fed rate cuts this year.
Janet Yellen wrapping up her visit to China, calling on officials to rethink their economic growth strategy and also warning against supporting Russia's war.
And I'm Haslinda. I'm in live on day 2 of HSBC's Global Investment Summit here in Hong Kong. Lots of conversations on the global economy and markets coming right up, including exclusive interviews with the lender's Global Private Banking and Wealth CEO Annabel and former St. Louis Fed President James Bullard.
All right, we're going to be looking very closely at those interviews at the HSBC Global Investment Summit, as has mentioned here, especially when it comes to Jim Bullard. What does he think about this whole debate right now across these markets between 2 Fed rate cuts this year or 3? Is the US CPI print going to be the one that determines? That is still the big question here so far. So we're still seeing a decent rally under place here. It's pretty quiet out there ahead of that key data on Wednesday. So we're up about 1/3 of 1% when it comes to Asia Pacific stocks. US futures are flat. The dollar is flat as well. And you are seeing, though, continued pressure when it comes to fixed income. You see where the 10-year yield is. We're just about, a little bit away, whisper away from 4.5%. That certainly is something that we're watching very closely. We're talking to the Amundi CIO in the next hour. He thinks 5%, that could be that cap when things really start to break here when it comes to this equity rally. We're watching very closely what goes on in the JGB market. There's a 5-year bond auction coming up later on as well. Governor Ueda from the BOJ is going to be speaking as well in Tokyo. So we're watching very closely what happens with dollar yen. Haven't quite hit that 152 level, just barely below that here right now. Continue to see this rally resume itself when it comes to Brent crude. So we're back above $90 here right now. And we're watching iron ore very closely as well, 104.75 in Singapore. In terms of what happened overnight, gold futures certainly is one thing we're watching, right? So we continue to see this rally. We're still at record highs. We're inching very close to 2360 here right now. I believe we've been up about 17% since mid-February. It's been nuts, this rally in gold. Golden Dragon did this, not a whole lot there, so not really telling us what's really going to do, when it comes to this equity market in China today. But this is what futures are here set up. Well, obviously, we're watching that fix once again here. We did see signs of stability in that fix on Monday, 724.36. We haven't seen a whole lot. We've been stuck in this sort of range, Dave, for some time. But futures are pointing higher this morning.
Yeah, and we just could snap, and we'll see how we open and close today. We could just snap a 3-day losing streak on the Shanghai Composite. In fact, just on that specific index itself. Your agenda for today. So we have been retesting. We failed to close above the 200-day moving average yesterday. We'll table the Yellen conversation for now because we'll revisit that in about 30 seconds' time. The fix, as Yvonne is pointing out, is quite big today. No big reaction in shares of Alibaba overnight, although we'll unpack certainly what this means in terms of strategy on them reducing the cost for the cloud services. And we are in the window for credit numbers coming out of China today, which includes things like money supply, for example, aggregate financing, new yuan loans, and all things in between. Futures are pointing up 0.2%. Right, Yellen, back on the table, back in Beijing, headed back out. She just wrapped up, of course, her visits by repeating her warning about overcapacity, especially in sectors including EVs and also lithium batteries. Have a look.
China is now simply too large for the rest of the world to absorb this enormous capacity. Actions taken by the PRC today can shift world prices. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
Let's get to our Chief Malaysia correspondent, Stephen Ingles, joining us for more and on what Yellen got out of this trip, and really how receptive do you think Beijing was to those overcapacity?
Well, they listened. They played nice, according to the sources in the Treasury Department who were in those talks. And, of course, she kind of came in with both guns blazing a little bit on Chinese soil, which was a little bit unusual. Usually they'll go and they'll be a little bit more diplomatic and then go back to the U.S. and then have press conference and kind of hit home on some of the big issues. But she was coming out swinging a little bit, and by most accounts, the Chinese listened. But what can they do? That's the big question, because this is Xi Jinping's mandate: new productive forces in electric vehicles, in batteries, in solar capacity. And again, when these kind of marching orders come down from the top, the investment pours in. And right now, with a slowing Chinese domestic economy not soaking up that excess capacity, the fear, according to Janet Yellen, is that they will export this and essentially subsidized products going abroad at dumped prices. So that is the concern that the United States has. But again, what can China do at this time is the big question.
On the Russia front, Yellen also warning here, particularly Chinese banks.
Yeah.
And especially banking, especially the military, of course, exercises.
Yeah, no, she wasn't laying out any evidence, per se, that the Chinese banks or China as a policy is supporting the war in Ukraine. Obviously, I mean, sure, Beijing supports Moscow in many ways. And Janet Yellen did say most of the trade that has surged over the last couple of years is not necessarily products that go for dual-use products into the Russian economy and for military use, nor is it necessarily military use. But what she did warn, she says, any banks that, let me just read the exact quote, any banks that facilitate significant transactions that channel military or dual-use goods to Russia's defense industrial base expose themselves to the risk of U.S. sanctions. So that was made on Chinese soil, basically a risk of doing what they've also done with Russia, and that is sanction the banks, and essentially the big weapon that they have would be to cut China off from U.S. dollars.
Yep. Yeah, that conversation, I'm guessing, with the PBOC governor there, Pan Gongshun. If there's one thing that unites, I guess, the U.S. and China is maybe what Yellen's been eating and drinking during her trip. In China, it's been everything from Peking duck, she has Sichuan food,
and then drinking pints.
Yesterday she had a beer that caused so much stir on social media. I was looking this up. Jing-A Brewery.
Yes. Been there many times.
Have you?
Yes.
Have you tried this Flying Fist IPA that she drank?
She had the IPA and Ambassador Burns had a lager, so she had the stiffer drink. But I'm asking, did she have the Flying Fist or did she have the Airpocalypse double IPA?
Yeah.
A little bit of a plug.
Is that your preference?
Maybe too strong for a work trip.
I like the double IPA, yeah. In my beer drinking days, I've been to this pub many days. I just don't drink the beer as well as Janet Yellen does these days.
It was co-founded by an American, though, that IPA. So
yeah, 12 years ago.
Yeah.
I remember when it opened in 2012 when I was the Beijing correspondent. It was a destination.
I love it, though. I mean, everyone's just been fixated on what she seems to be a foodie, though. Everywhere she travels, she's trying to look for the very authentic places.
Yeah, and then end with a beer. Butter. What de-risking, right? The American-owned pub is still open at the center of the capital there. Stephen Engel, our chief North Asia correspondent there. Maybe she was cheering the eclipse as well. Who knows? We're looking at treasury markets. We're also looking at this break-even. By the way, in case you missed it, the two-year break-even yield in the U.S. rate is now back at the highest level in 13 months. Treasury yields just about up a little bit across the curve, across your screens, 4.8 right now in your two-year yield. Garfield Reynolds is with us to talk us through macro and markets and inflation coming through. Garfield, tomorrow out of the U.S. Just your thoughts on the path of Treasury yields these next 36 hours, Garfield.
Well, there's little reason to expect them to come down at least before CPI comes in, and it's going to take a big downside surprise for, broadly across the CPI report to seriously bring yields down, given there are so many reasons to be worried about the idea that the Fed can cut rates anytime soon. The most optimistic forecast for headline inflation is 3.1%. That's still, you're pretty much stuck above 3%. That's where headline inflation has been for most of the last 6 months, if not longer. And in that same period, inflation has got stuck. It's not disinflating anymore. The break-evens, as you were mentioning, they've come up. And if you look where the break-evens are now, they're close enough to the actual inflation rate to signal severe doubts in the bond market that the Fed will achieve its inflation goal, especially sustainably, over the coming 1, 2, 3 year time horizon. And with that being the case, even an inline inflation report could still send Treasury yields significantly higher, bring into play that 4.5% initial potential barrier for the 10-year yield.
So do you think this data, I mean, what's expected? I mean, obviously we're expecting maybe the pace of these gains are going to ease a bit, but core inflation is still well above that 2%. Is this data point going to settle this debate between whether we're going to see 2 Fed cuts this year or 3?
Well, I mean, that debate is very much an open one in the markets right now. We've fluctuated between 2.4 to 2.8 rate cuts priced in for the year when you look at the swaps curve, and we're towards the bottom end. So, yeah, if we get an inline result, we'll still hang around at this 2.4, 2.5, 2.6 cuts priced in. If we get a strong print, we could see it drop back down towards 2 rate cuts priced in only. And to be honest, that seems like a far more realistic pricing at the moment, because we also have, we don't have a rate cut fully priced in until August or something. July is possible, but if you get no cuts until July or later, you run out of runway, as it were, for 3 cuts, unless you think the economy is going to go so badly that the Fed is going to go cut, cut, cut. And the economy doesn't look like it's doing anywhere near badly enough for that.
Garfield, just a quick word on the yen. Do officials need to somehow come out with some preemptive measure in case we get a nasty one out of an inflation print in the U.S.? Because the yen still, in fact, right now, still hovering very near 152.
Well, I think, for one thing, the yen, in some ways it's surprising the yen hasn't gone through 152 already. There's even some talk that the authorities might be willing to let it go through 152 to, flush out some of the positioning and make it easier for them to then bring it back down. I don't see a lot of traction in moving preemptively because, well, maybe they get a good data release. There's also, we've had all these tests of 152. The market seems somewhat reluctant to seriously test 152, probably partly also because the Fed is staying easy. So I'm not really expecting them to move before the CPI, and you might be surprised at how little they need to move after the CPI. After all, that jobs number last week was incredibly strong, and yet the dollar yen rode that out, with some level of equanimity.
Garfield, thank you. Garfield Reynolds there joining us from our MLive team. Coming up on the China Show, we're going to be live from the HSBC Global Investment Summit in Hong Kong. Their CEO of Global Private Banking and Wealth, Annabel Spring, joins us exclusively next. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. Happy Tuesday. Futures up this morning.
Right, welcome back. You could, in fact, replay a version of the episode of the show from yesterday because the fix at midpoint is just about the same levels as we had really the last few days or so. There we go. In fact, the headline coming through, the PBOC keeping the fixing steady after the yuan dropping near the policy red line. 709.56 on the weaker side of things against the U.S. dollar.
All right, day 2 of the HSBC Global Investment Summit. That's getting underway in Hong Kong today. Our very own Linda is there with our next exclusive guest. Has.
Hey, Yvonne. Joining us now is Annabel Spring, CEO of Global Private Banking and Wealth at HSBC. Annabel, good to have you with us.
Thank you so much.
Given the current investment climate, how are the wealthy people looking at their risk appetite? Where are they putting their money?
Well, before I say anything else, diversification is key. So always asset class diversification, always global diversification. So putting their wealth carefully. But given where the economy is and given where rates are, right now everybody is putting their money to work, and we highly suggesting to our clients, please put your money to work. So we're tactically underweight cash, and we're overweight global bonds and global equities, and for the ultra high net worth and the high net worth, we're really talking about alternatives as well. But in global bonds, and as we look across fixed income, we're looking to stretch out duration, particularly at quality, so that you're really taking advantage of those yields at the moment and locking them in for the medium term, and that's really important. As we look at global equities, though, it's a slightly different story, and we're quite selective there. So as we look at, given we're sitting in Hong Kong right now, as we look at ASEAN equities first, we're overweight for different reasons, for Korea, India, Indonesia and Japan, and different reasons provides a certain sort of diversification. But we're actually underweight China at the moment. The overhang of the real estate, going into consumer confidence, business confidence. But we're watching it very, very carefully though, because we're starting to see net inflows, we're starting to see those policies coming through, starting to see a little bit of an uptick on manufacturing. So that's a short term, and we're watching for the long term in China. But as we look at the Western economies, very strong in the US, we've seen some surprising resilience. We're looking at the reindustrialization of the US, right. Whether it's healthcare innovation or tech, obviously, a lot of talk about AI at the moment, particularly from all of our clients, particularly the ultra high net worth as well. But really looking at the changing shape and the reshoring in the US.
Annabel, you talked about how you're starting to see some improvement in China. Do you see a turnaround in China in 2024?
Probably not in 2024, but we're watching really, really closely in the medium term and the long term. And obviously we're underneath the macro, there's some really interesting selective plays. So always looking for those pockets of opportunity.
In terms of your positioning in the world, I mean, HSBC lost its top spot in the wealth space when we had, UBS buying Credit Suisse. Are you keen to regain your top spot? What are you doing about it?
We're very keen. We're very keen to be the leading wealth manager across Asia, obviously, and for the private bank, we're looking at being the leading international private bank for Asians, international clients, and obviously for entrepreneurs, given our positioning. So very keen. As we look at Asia in particular, we're investing across the space. So let's start with China, given we talked about that already. As you would know, we just acquired the Citi's Chinese, mainland Chinese wealth business, and we're incorporating that into our personal banking and our private banking business. We're very strong already with our joint venture there in asset management. We have the life business. We actually have 1,400 mobile insurance people there, and first one ever, we've also got a fund license so they can distribute insurance and funds, and we're backed by a strong retail bank and a strong business bank. So,
are you looking at more deals to come? I mean, we've seen a lot of bolt-on acquisitions. Are you looking for more?
We never comment on acquisitions, but we are extremely ambitious in Asia. And that's what we've done in China. Obviously, we've acquired. We've also acquired in India, though. So we've acquired L&T in India in asset management. We just launched a private bank there as well last year. And we try to put our money where our mouth is.
Speaking of putting your money where your mouth is, looking at expansion, are you looking to hire more? Do you have, capital headroom to do it?
So when I look at India, we say it's the investment destination of the decade, and we've just launched a private bank, and we're adding people. So as we look, we really are following up those things. So India, we're also looking at more insurance and how we distribute insurance in India. That's an area of emphasis. So wealth, insurance, asset management, and trust, being a comprehensive wealth management player, again, always backed up by the balance sheet and the strength of the retail and the business bank in India as well. But we should talk about around the region as well. So we've also launched onshore in Thailand. We've launched wealth in the Philippines. We're really looking at a comprehensive plan for Asia.
But in terms of the biggest opportunities, would that be what? Hong Kong, UAE, Singapore, possibly? Can you name a market that you're really excited about?
We're always excited about Hong Kong, especially when we're sitting here, but we are always excited in Hong Kong. It's one of our home markets, but we are expanding through ASEAN. So Singapore, China, India, all big focuses for us,
but give us a sense of the kind of growth you're anticipating.
So we're looking, as we look at the market, we're looking to considerably outpace the market growth in each of those regions. And I should have actually mentioned that you're right, the Middle East. So funny story, I was sitting last night with a client, and big Asian client, but all of the conversation was around the Middle East. You know, we look after their children who are at school in the States. They're going to college there, but they're looking at investing both for their business and for their financial wealth in the Middle East. And I think that speaks to what you're asking, which is that repolarization, that shift, you know, it's from Asia into the Middle East and back and forth. We're seeing it in trade and we're seeing it in investment.
Before we let you go, Annabel, give us a sense of the kind of wealthy customers you're attracting right now. Are they younger? Are they wealthier? Just give us a profile of who you're attracting.
I think wealth is rising everywhere. There's a huge rise in family offices, particularly in Asia, in Hong Kong, in Singapore. That's a big part of our business. But the young are a big part of our business too. I think digital is attracting them, and we're doing some cool things. So we just did gold tokenization in Hong Kong. And I think the young are really interested in those digital experiences and those interesting asset classes that we're adding.
Annabel, good to have you with us. Annabel Spring, CEO of Global Private Banking and Wealth at HSBC. Dave, day 2, and we know that, you know, participation, 3,500 people all keen to know where to put the money and what to do with their money. Dave.
Yeah, there you go. I've actually never seen the Conrad that decked out in another branding. HSBC draped all over the place there. So yeah, day 2, and someone else is, by the way, headed there tomorrow. Anyway, we'll keep that secret for tomorrow. There we go. Coming up, James Bullard will be speaking with us, with has there on site, and perhaps we're talking Fed and inflation there, maybe because of the Fed conversation. Dollar yen should be coming up bottom of your screens, I believe. We're now closing in on 152, 150, 190 right now is the exchange rate. There we go. This is Bloomberg. Yep, we're going into the Tuesday session, 4 minutes away, and it's looking like we'll be seeing a higher open. As you can see, 0.5% offshore. Onshore might be looking to snap this 3-day skid.
In terms of analyst actions, there is an interesting note from JP Morgan on the property sector, particularly when it comes to China Jingmao cut to underweight there. But Hong Kong developers, Carl Chan saying that Swire Properties could be raised to overweight from there, just given that despite this policy easing, we haven't seen these developers see a meaningful rally. Also, Kuaishou Tech rated new ad at Huachang with a price target now of about $69.
Okay, looking at other stocks we're tracking here as well, some approvals here. 14 imported online games, gaming stocks on the way up. Yvonne mentioned Kuaishou, of course, in terms of analyst ratings, and of course, gaming stocks also in focus. And you know what? We don't have time for this. We'll tell you why on the other side of this break, which includes, of course, the opening bell. This is Bloomberg.
Watching the China show, we're counting down the open of markets here in the Greater China, and you're seeing, at least in the pre-market in Hong Kong, at least some upside, about 0.5%. So hopefully we'll see a second day of gains here. CSI 300. We'll see also A50 futures are punching slightly to the upside here this morning. Not a whole lot of movement with that fix, of course, as we said, pretty steady with that fixing here once again. I believe it's the 10th straight session, Dave, we've seen that fix sub 710.
Yeah, and certainly no reason to believe at this point that we don't get to an 11th day ahead of U.S. inflation late tomorrow, where certainly stability is the name of the game here. Potential for dollar strength going into that as well. I mentioned that we talked about the yen, for example. As we speak, we're at 159.
151.
158.90. There we go. 151.90. Sorry, we could get to 159 when you look at some of these shorts out there right now. Biggest net short on the Japanese currency in 17 years. CSI 300. We actually looked like we were going to open slightly high. We're now seeing some slight weakness across that as well. So if things do remain like this, 4 days of weakness onshore, Hang Seng Index maybe getting a little bit of a boost. HS Tech right now. We talked about about gaming shares right now. Citi putting out a note talking about how we might actually see more approvals coming through as well. Shanghai comp flat, some of the other benchmarks here as well. We talked about the currency markets, dollar China here. And of course, you have a pickup again in crude. And we were looking at iron ore yesterday, a very big rally, a further rally today in the early goings. Flip the boards, please. China Mobile out. I believe it was Citi cutting that to, before we get to that, some of the gold mining plays, by the way. So, which, by the way, I should mention, because of the rally we've seen recently, at least a 60% rally in some of these names from the lows just this year alone. Keep that in mind. Some, if not all, were actually in overbought territory when you look at some of the technical indicators. Flip the page, please, if we can. We're looking at, well, just call out a Citi and China Mobile. This is the A shares you're looking at right now. Yvonne was talking about some of the other changes from JP Morgan coming out. Jinmao and also Swire Properties. Swire Properties actually getting a boost there at JP Morgan, and Kuaishou also getting a change from analyst actions here. Now, very, very quickly, so where are we in this rally? A few days into April, a few days divorced from the last earnings season. We're entering, of course, another earnings season. So the question is, with the rally we've seen, are we closer to yellow, which is the peak in 2015, or is this more 2016, the version in green? And I think the folks at UBS, Yvonne, think it's probably the more encouraging of the two options.
Let's see if he's right. And we'll ask James Wang there, head of China strategy at UBS Investment Bank, right? You know, are we talking about just a false start this year, given that sentiment has turned a little bit more positive, or are we still talking about a sustained recovery? James Wang, thanks so much for joining us. It's been a while.
Yep.
Yeah, what are the parallels that you're seeing to 2016?
So we looked at a couple of things. We look at the macro data, we look at the different markets, and we look at company earnings. So if we start with the macro side, if 2015 and 2016 is similar to China right now, in the sense that we're still going through deflation. Back then, PPOs were negative. And 2015, exports were also quite negative, whereas now, exports are actually a bit better, so closer to 2016. And 2015 is also when some of these stimulus measures really came in, like Shanghai renovations, like supply-side reform, like interventions from the CSRC. And we're also seeing that now in 2016. But we've had some more time when the stimulus kicked in, more closer to what happened in 2016. So I think the macro side, while you can argue retail sales not as good as what it was, but I think we're closer to 2016 episode than 2015. But on the flip side to that, the company earnings are much better. So companies actually delivering positive profit growth. It's mid-single digit kind of growth, but still decent compared to the declines we've seen in 2015-16. Company balance sheet, listed company balance sheets are much better than what it was. Free cash flow generation is at a historical high. And capital returns are also better. Payout ratios at a historical high. So I think at the micro level, at the listed company level, it's better compared to the macro. And then if you look at some of the other markets, like commodities, like credit markets, conditions, I'd argue also closer to the 2016 recovery than what it was in 2015.
What about sector valuations?
That's another good point, David. So if I look at headline level valuations now, is closer together. So for the market, it's about 9.3. If we look at 2015 recovery, 2016 recovery, both had a 20% rebound off its lows, all close to 9.3. But if we split it between different sectors, actually 10 out of the 13 sector valuations are below what it was in 2015 and 16. Only 3 were above. So at a sector level, it's lower, but the mix has changed. So higher proportion of high growth companies making out a bigger portion of the index makes the average closer to the historical average.
When do you think those valuations matter, right? I mean, when I take a look at a market like Japan, I look at India, I mean, it's getting pretty lofty there.
Yeah.
China's been cheap for more than a year or two.
Correct.
When does it actually matter that these valuations are so low?
I think, I mean, when it got to 8.2 times, people start definitely looking at it. And a lot of the sell-off, particularly at the beginning of the year, was technical driven. And I think that's what brought a lot of international investors actually coming in to look at the China, because look at the other markets, they look lofty, right? And so that's what I think drove the recovery in the last month or so. So I think recently with the market recovery, we still continue to get a bit more interest coming from international investors because of the relative valuation that China still offers.
The big difference I can think of, though, not to push back, but certainly a big difference unique to this market in terms of what's happening now and also the magnitude is rates are higher now than they were in 2016. And also there's a big demand gap that wasn't present in 2016, which is the property market.
Yeah.
So how do we account for, I guess, those idiosyncratic factors that seem to be present in one but not in the other?
So interest rates in China, the interest rates in the US definitely higher, but in China it's actually lower. Right.
But don't they matter though, where the Fed is?
But the property market, definitely, it's definitely weaker compared to what it was in 2015-16. I mean, the Shenzhen renovation, they had the government stuck in 3 trillion, whereas if in the PSL, whereas now it's only 500 billion. So the size of the stimulus is lower, and you'd argue that the excess inventory issue is probably worse compared to what it was because most people would have got housing. But the adjustment has also been quite violent. Right? You look at property sales now, it's the lowest it's ever been. And you look at land sales from local government, it's extremely low. So the destocking is happening. So as a house, we expect property prices to continue to decline, but destocking to pretty much finish by the end of the year, and property prices stabilize at the end of the year. So perhaps next year we'll see a fundamental property sort of recovery-driven rally. But I'd say that's quite arguable between investors. Most investors don't believe that, and I guess that's being reflecting the valuations. But I'd say that if we're right as a house, that we can, I think there's still a lot more room.
What does this mean for stock picking then, James? I mean, what lessons can I take from 2016? What actually outperformed?
And that's the reason exactly why we did that comparison, to put some framework around, okay, the market has recovered from its lows, what stocks to buy? And that's the question we get a lot from investors. And if we look at the 2015-2016 episode, 3 things really struck is that earnings have become a much bigger driver of stock prices. So stock price were more rational post that first irrational sort of decline. And so that's the first thing, follow the earnings revisions. And number 2 is companies, the large caps generally performed better than the small caps, and defensives did not necessarily underperform. So that's the other thing I'd say. And
near-term gainers, you said, right?
Initial gainers. And so those that did well initially continue to do well in the following subsequent quarters. So this earnings season to me is quite important because it'll tell us what are the initial gainers, and I think the market is going to continue to embrace those until they find new trends in the economy or in the market.
Well, what in terms of the earnings revisions and on the forecast stand out to you at this point in time? Because that would drive, to your point, where we go 6 months from now.
So the earnings numbers do have swung quite a bit by week, as a lot of companies report. But the one sector that really stood out was the internet sector. I mean, earnings were much better than expected. Revenue still struggled because of the low inflation, but margins were much better than expected. And capital returns, in terms of dividend payout, in terms of buyback, is also a highlight from the internet companies this reporting season. So I think that sector is going to do well in the next couple of quarters.
There we go. James Wang, let's hope you're right. Not politically, of course. Right or left. Correct in terms of this report. Head of China Strategy at UBS Investment Bank Research. Right. Markets, onshore markets are flat right now, a bit across coming through. Stocks here in Hong Kong. There we go on your screens. MSCI China 1%, give or take. Hang Seng 1.5%. Plenty more ahead. This is Bloomberg. All right, Tuesday we're looking higher, looking up here across these benchmarks. Most qualified, not all. CSI 300 flat, MSCI China, where you're really getting the bigger representation and growth in tech is where you're getting the most gains. In fact, there we go, 1.4%. Nearly all stocks on this HS Tech Index are up. Alibaba, we're looking at that very closely, 0.8%. The news here, the company's cutting prices for cloud customers globally by as much as 59%. That's, if it's not obvious, in a bid here to gain market share. Let's bring in Robert Lee to talk us through the implications of what this probably means here for the company as well. I think of margins immediately. What's the immediate impact here?
Sure. Just briefly take a step back. This company effectively aborted or put on hold the planned spin-off of the cloud business earlier this year. And I think one of the main reasons for that is there wasn't really a growth story there. So looking at their cloud intelligence revenues in Q4 of last year, calendar Q4, they grew 3%. So, you know, one prerequisite for any IPO, there has to be a growth story for people to get their teeth into, and it isn't there. Therefore, to reinvigorate growth, the company has, I think, limited options, strategic options at the moment, the main one being price cuts. And that's what we've seen both in the domestic China market and now doing the same thing overseas. But the problem is the market is hyper-competitive. The barriers to entry are low, so I would expect Tencent, JD.com and others to follow suit. So, you know, what's their competitive edge? It's quite hard to see, apart from their scale in being the largest cloud provider within the China market.
And you've mentioned this last year's price war didn't do much to really spur any new business. Where are we in this sort of price war now? I mean, it seems like Huawei stands out among the pack still.
Yes, I mean, given the nature of China and the economy, the state takes an active role in the development of the digital infrastructure, and so you're seeing a sort of swing towards either SOEs and state-aligned companies such as Huawei, which is probably one of the main suppliers to SOEs in the governmental sector. So in terms of market stats, we've seen Huawei progressively gain share over the last few years at the expense of Alibaba and Tencent, and that's a trend we think will continue through the rest of this year and, in fact, for the foreseeable future. The telcos, I should also mention, again being SOEs fundamentally, China Telecom in particular is also gaining share. So there's a shift in dynamics there. But as you asked in your initial question, I think there's clearly going to be a margin impact here. These businesses are either loss-making or marginally profitable to start off with. So if you're slashing prices by up to 59%, it's clearly going to impact your bottom line.
Right. And to the broader point, as you just made there, I mean, are the private players the bit players now, because the dominant ones are, to your other point, the SOEs here? In other words, is Alibaba fighting for market share against this pool of private players in this market, and then while the rest of the market is dominated by the SOEs?
Yes, I think that's one way of looking at it. But if you compare and contrast with a market like the US, the market has consolidated. It's dominated by the likes of Microsoft with its Azure product, and Amazon and AWS. So the question is, why aren't you seeing the same thing in China? Because there are just too many competitors with very healthy balance sheets, with the input of the government. The market is just awash with liquidity, and therefore you haven't seen that shakeout of consolidation in the industry. You've got too many players, and so until that happens, I think the market remains ultra competitive and these companies remain loss-making in aggregate. There's one other point I wanted to make, if there is time.
No, since you put it that way, we don't have a choice but to give you time. Go ahead.
Apologies. I'm trying to add a little bit of value here. One thing when
get the drums up.
On the company press release that came out yesterday, they highlighted a number of countries they're looking to expand into with the price cuts, including the likes of India, Malaysia, Japan, etc., but also, I would say, quite surprisingly, the US, the UK, and Germany. Now, I think geopolitics is really having a massive impact on the sector at the moment, because data security concerns are at the heart of, and national security concerns are at the heart of the geopolitics at the moment. So is it realistic in this current political environment for a major UK corporation or a US corporation to suddenly put their data on Alibaba Cloud? I would say that's highly unlikely. So therefore, realistically, to what extent is Alibaba going to gain new share in these other markets? I think it's very limited chance in these major Western countries. And if you look at some of the Southeast Asian countries that they earmarked, these are very, very small markets. One quick number. India, cloud revenues in 2022, 6.1 billion. The US is 305 billion.
Wow.
So it's a very small market.
Quite a gap there. All right, Robert, great to have you. Thank you. You always bring value to our show. Thank you, Bloomberg Intelligence senior analyst here on Alibaba. Let's talk a little about one stock, TSMC.
Yeah.
Are we at record highs again?
3.3% to the upside,
wow.
$800. I mean, this one has been pushing highs and new highs almost on a weekly basis, really. Just keep in mind, right, at the start of the year, we were closer to about 545. We're now trading at $800 there. So, and of course, the big news here, in case you missed it, was, of course, this $12 billion in grants and loans that's going to help the company build chip factories in Arizona. Peter Elstrom, our Asia Tech executive editor, is here with us, in fact, on the set, to talk us through how this award does fit into investment plans that they have in the U.S. already.
Yeah, so this is a pretty big award from the U.S. government. We knew that the U.S. government was going to allocate some money to TSMC, to Samsung also, and to Intel, the big American chip player. But what we're finding out now are some of the details of these awards and how it's going to fit into the broader investments that these companies are making in the United States. So in this case, the U.S. government is giving TSMC $6.6 billion in grants, and it's also providing at least $5 billion in loans for the company. This is part of $65 billion that they're going to invest in the U.S. So it's an enormous project by the leading chip company in the industry right now. It's very important strategically. And one of the surprises that came out of this announcement is that TSMC is already building 2 fabs within the United States, and it's planning on building a third. This third one is going to have the most advanced chip technology that we've seen in the United States ever, really. And they trumpeted this idea. Gina Raimondo, the head of the Commerce Department, talked about how important the so-called 2-nanometer technology is going to be as TSMC brings what has been very sophisticated chip technology into the United States. And it's important so that the U.S. economy, U.S. companies have a domestic source of these chips that are going to be so important to technologies of the future, like artificial intelligence, like quantum computing, like electric vehicles. So that's sort of the significance here. TSMC is not the only company that's doing this, but they're the most important.
Why do you think the U.S. is still allocating so much money into the chip industry, for one thing? I mean, there is also this concern about the U.S. being over-reliant on Taiwan, which also is exposed to a lot of geopolitical risks, too.
Right. Back in the old days of globalization, when we had free global trade and we didn't have interruptions, it was okay for production to be consolidated in a handful of places. Supply chains were working smoothly. What we saw with the COVID pandemic in particular is we saw these disruptions that left the automotive industry, for example, without any chips, and therefore in the United States, in Japan, and in Europe, all these companies had to shut down their plants because they couldn't get enough chips. That, of course, was a concern. We also have rising geopolitical tensions between the U.S. and China over Taiwan. So there's been this push by governments, particularly the U.S. government and Japan also, trying to diversify the means of production so that they have more security in the supply of these kinds of chips. The U.S. has actually been a little bit behind here. The Japanese government has moved very quickly. They've already given money to TSMC. TSMC had an opening ceremony for their first fab in Japan a few weeks ago. So the U.S. is a little bit behind here, but the scale of the investments in the U.S. are very big, very ambitious. TSMC is part of that. Samsung also is going to have some announcement in the future. And already we've heard that Intel, again, the leading U.S. chip supplier, Intel is going to get a lot of money also to build up domestic capabilities.
All right, Peter, great to have you here in Hong Kong. Peter Elstrom, their Asia Technology Executive Editor on TSMC. We got plenty more ahead. This is Bloomberg. All right, we got some breaking news when it comes to L'Occitane here. Of course, this is a cosmetics maker that's listed here in Hong Kong. There is talks, according to our sources, that Blackstone is said to be near taking this company private. We've been talking about this for, gosh, close to a year now, it seems. And we're finally getting maybe closer to the finish line.
Yeah, from July at least last year, 2023, when at that point, and really you look at the stock price, it does reflect, if you go all the way back there, it does reflect the ins and outs or the offs and ons again here, where the chairman was said to have waived the buyout, and the company then confirmed those talks, and then that pulled out. Then the chairman again ended those buyout talks. And the most recent, before the news of today, was Blackstone was said to mull a bid that was in Feb of this year. A few minutes back, the company halted trading of shares on the exchange pending a takeover announcement based on the code on the exchange. And then we have the scoop, of course. That perhaps indicates what that announcement might actually look like these next few hours.
So we might get that confirmation soon. We'll let you know once we do. But yes, if it does, if it's confirmed, that would end L'Occitane's 14-year run here in Hong Kong. All right, checking markets.
Yeah, TSMC, we talked about this, and that massive incentive, of course, back in the U.S. So at 809, this is a new record here for TSMC and all the related, obviously, shares across the entire sector here. although not created equal. Gold and iron ore plays very much in focus. Gold, I believe, is still near or at record highs, depending on the contract you're looking at, but still elevated, I guess, is one way to describe it. We're getting a pullback across some of these gold-related names, which we should note going into today did have a fair bit of momentum and did exhibit some overbought signs when you look at some technical indicators. The benchmark's looking like this about 23 minutes into the session, and more weakness coming through, or the lack of strength, rather, onshore than offshore.
Yeah.
Hang Seng Tech, of course, was one of the big gainers today.
Yeah, and we're seeing the Hang Seng up about close to 0.9%, and HS Tech certainly is driving a lot of those gains here this morning. As you mentioned, onshore, we're still seeing a bit of pressure here in the CSI 300. We're down about 1/3%. But yeah, you're seeing HS Tech. It's the gaming stocks with more approvals. Maybe Citi had a pretty interesting note that this could be the start of something more positive as well. That's certainly one to watch here. Obviously, with the Alibaba news of them slashing really those cloud prices again this year. And we're still watching commodity futures, right? Like, look at what Shanghai crude's doing. We're up 1.5%. For oil, iron ore, Dalian futures up, surging some 3%. Dollar China not doing a whole lot though, 724.53. So we're still seeing a bit of a holding pattern there, and we're not seeing a whole lot of movement on CGBs here this morning as well. Coming up in the next hour, we're back at the HSBC Global Investment Summit, where we'll discuss the latest Fed speak with the former St. Louis Fed President James Bullard, also Amundi CIO, joining us as well.
Welcome back to the China show. CSI 300 session lows. We're looking at volumes on the lighter side of things. Most stocks are still down. About 180 stocks are lower. 115 on the way up. 4 unchanged. So at this rate, we are on track for a fourth day of losses onshore, although quite mild at this point in time, against the broader backdrop, Yvonne, of fairly healthy risk appetite out there this Tuesday.
In fact, quite a decent rally that we're seeing across the region here, with the exception of China, as you say. Hong Kong, though, seems to be doing quite well still today. But you take a look at how risk sentiment is looking like ahead of this U.S. inflation print on Wednesday. It seems like it's still looking pretty good here right now. Taipei certainly is the outperformer. We're up about 1.2% in the TAIEX here, thanks to, of course, TSMC getting that $12 billion in grants as well as loans from the U.S. and really helping them in their whole global expansion efforts here, building plants in the United States. So that certainly is what's lifting the TAIEX here this morning. We're watching treasuries very closely. 441 for your U.S. 10-year yield is 450 in the cards after that CPI print. That certainly is where all the angst, the nerves are, and potentially where you are when it comes to the dollar yen, as Dave has been blogging about in the M Live this morning, about the 36-hour window of nerves that traders might have with dollar yen if we get a pretty punchy U.S. inflation print as well. 151.89 right now. We're not quite to that 152 level, but you take a look at what's been going on in commodities, and it does add to those inflation pressures, right? You look at what Brent crude's doing. We're still above that $90. Iron ore in Singapore is also above 104 as well. We talk about gold still at that all-time high. We've rallied some 17% since mid-February for the gold price, and everyone's still scratching their heads on what's really driving this gold price here right now. We also have heard from the hawk among the Fed, right? The Minneapolis Fed President Neil Kashkari, what sent markets a bit shocked, maybe in the bond market in particular, was his call, or at least his sort of idea, or floating this idea of no rate cuts this year. He's talking a little bit more about the jobs market now, and how he says, look, things are still looking tight, but you can't quite call it red hot. Take a listen.
The labor market is not red hot the way it was a year ago or 2 years ago, which was just crazy hot, and they had to keep paying up to keep their workers in place, let alone trying to find new workers. So it's not that red hot, but it's still a tight labor market. They're still having to compete to find workers.
Right, and certainly ahead of the inflation print coming out late tomorrow, it's almost coin toss odds on June, and will there be a number soft enough that properly brings June back in, or do we say goodbye to June at this point in time as far as that first rate cut is concerned? I mean, can we even consider July if that comes in very hot? Let's cross it over now to the HSBC Global Investment Summit, inaugural one here in Hong Kong, and Haslinda Amin is there with a perfect guest to discuss that very question.
Well, that's right. The perennial question, how many times will the Fed cut? We know yields at the highest level this year. Well, joining me now from St. Louis, Fed President James Bullard. Jim, good to have you with us.
Great to be here.
You know, we hear Powell keep saying that rates are restrictive enough, yet data comes in hot, continues to be hot, and core CPI is likely to remain very sticky. So, how many cuts? We've gone from 7 to 3. Are we likely to go to 2?
I think at this point you should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case. I think it's been a very successful policy. The policy rate was increased a lot during 2022, and inflation fell quite a bit in the second half of 2023. Last year at this time, core PC inflation would have been 200 basis points higher than it is right now. That's the committee's favorite measure. So you're looking at a very successful policy with a pretty strong economy. So a lot of things going right for the Fed right now.
So Powell has been right so far?
Yeah, I think he's been right so far, and the committee's been right so far to pursue an aggressive strategy to bring inflation back to target. Most of that was in 2022, and then you bore the fruit in 2023 and into 2024 here.
We talk about how the Fed is data dependent. Powell himself says he is data dependent. What exactly does that mean, and which data in particular is he looking at, should be looking at?
Yeah, I think right now it's mostly the inflation data, because on the real side of the economy, things are going very well, and you can argue about why, but they're going very well. The committee doesn't really have to worry about that side of the mandate right now. All they've got to worry about is getting inflation back to the 2% target, and they've come a long ways back already. It was 4.8%, now 2.8% core PC inflation on a 12-month basis. That means you've only got 0.8% to go. And some people are saying that the next report will lead to core PC being only 2.6% on a 12-month basis. So you're starting to get close enough. I think you have enough data in hand right now to justify the first rate cut. Maybe not a whole string of rate cuts, but you could certainly justify the first rate cut now based on the data that they have.
We talk about how the U.S. economy is very strong. So would you say that the risk in the U.S. economy right now is inflation and not growth? Fair to say that?
I think that's right, yeah.
Why is the U.S. economy so resilient? I mean, not too long ago, we were expecting a recession, 100% or, priced in of a recession. Yet here we are with a very resilient economy.
Yeah, last year at this time, you had the bank failure of Silicon Valley Bank and other banks, smaller banks around the country. That was overinterpreted to mean that the U.S. was going into recession. I don't think it was ever a good story to tell, because, yes, their banks failed, but they're only a small fragment of the total banking and the total intermediation sector in the U.S. economy. So I think that card was overplayed, and not only did the U.S. not go into recession in the second half of 2023, but the economy actually boomed in the second half of 2023. So you really got a very strong outcome, and that has continued into the first part of 2024 here. Although I would say we're going to be closer to the trend growth rate now, not way above trend the way we were during the last 6 months of 2023.
Some people talk about the U.S. economy being a two-track economy. What's the risk in that?
What do you mean by two-track?
Like, there's some parts of the economy that's actually very weak.
Yeah. I think that's always the case, probably, in any really big economy. There are always some things that aren't going so well, or some markets where there are problems. But I think that it's very encouraging that the overall picture is very strong for the U.S.
neutral rate? Of course, that is the big question. Some say, well, the Fed says it's 2.6%, but we have the likes of, I can't recall his name now, but, indicating that it is 6% or above. Larry Summers, for instance, says that.
Okay. Yeah, the committee's number is 2.6. I think that's going to be ratcheted up here, but it wouldn't go above 3 or 3.5. So the policy rate right now is, the top end of the policy range is 5.5. So that would take quite a bit to get it down to 3.5. And, you think that's eight rate cuts at 25 basis points a meeting. That would take quite a while. This takes a whole year. One of the things I'm concerned about is that if they don't get started soon enough, then everything else will have converged and you'll be at the soft landing, but the policy rate will still be too high. And I don't think they want to be in that situation because that would risk overshooting on the inflation target and having inflation go below target, or risking more recession than you want to take on. So I think it is an art form to get this to the right level at the right time. Europe is looking, I think it's very instructive. Europe right now is already projecting that they'll overshoot the inflation target and have inflation below target in 2025.
You talk about the risk of the Fed possibly being behind target, behind the curve, so to speak. How do you assess that risk that it may be behind the curve?
Yeah, I don't think that this has really come into view yet because things are going so well. So it's a good problem to have. The economy's doing well. Inflation's coming down. But if you don't pay attention to everything that could happen, you might weigh the probabilities a little bit off. So it's maybe a minor problem to have, but it's something to keep an eye on in the months ahead.
Should the Fed taper off its balance sheet runoff?
Yeah, I think the committee has had a quantitative tightening policy since spring of 2022, implemented in the fall of 2022. I think they're going to slow that down based on comments at the last meeting, but it will still be a quantitative tightening policy, just not quite as fast as it was. And I think that's perfectly fine. I think it makes sense to shrink the balance sheet.
It doesn't make sense if it does.
It does make sense.
It does make sense. How much further then?
Well, I think they want to get the level of reserves to be the right level for the current economy, and they think they're too high right now. But I think they're moving in the right direction. This doesn't seem to be impacting other parts of the policy, so I think they've got the right plan here.
Of course, we have the U.S. election at the end of the year. How might that factor into Fed thinking and shape what it does?
So I don't think it really factors into monetary policy, at least not ordinary monetary policy. And I don't think you can win an election based on what the central bank does in September or August or something. I don't think so. I don't think the typical voter, the median voter, doesn't look at that and doesn't really know anything about that. So for U.S. politics, it's a lot about cultural issues.
Just one final question, Jim. Trump 2.0, what might that mean for the U.S. economy?
It sounds like he'll be ever aggressive on trade as he has been in the past, although I would say the Biden administration picked up a lot of the Trump-type policies, and so from a trade perspective, it may not be all that different than it was under Biden.
James Bullard, we thank you so much for your insights today. There you have it, former St. Louis Fed President James Bullard from a very noisy investment summit here at HSBC. Yvonne, handing it back to you.
Yeah, it is definitely busy, and we're hearing it. Great stuff getting through that interview. Still ahead on the China Show, Janet Yellen wrapping up her Beijing visit with a warning against any aid for Russia's war in Ukraine. We have details later on this hour.
But ahead of that, Amundi Group tells us where they're actually seeing opportunities in this global market, particularly in this part of the world within the Chinese equity complex. The CIO joins us exclusively in a couple of minutes. This is Bloomberg.
but we're actually underweight China at the moment. You know, the overhang of the real estate, going into consumer confidence, business confidence. We're starting to see net inflows. We're starting to see those policies coming through, starting to see a little bit of an uptick on manufacturing. So that's a short term, and we're watching for the long term in China.
We're reaching a stage where capital, whether driven by machines or indices, has concentrated too much in certain parts of the world based on past momentum. And that's when accidents happen. And you need to, sensible investors, diversify ahead of that, sacrifice some returns, but ultimately retain their capital. And I think we're in one of those phases where unfashionable asset classes should be attracting sensible investor attention for that reason.
The debates to build further exposure to a winning U.S. equity market, to diversify and risk, not at all, but certainly risk some returns by going into unfashionable parts like this Chinese equity market. Let's throw fuel on that fire. Joining us here on set to add to the conversation, Vincent Mortier, Amundi Group Chief Investment Officer. Good morning. It's very nice to see you. I know you were just at that, of course, at very conference as well. So why don't you chime in on this debate? Equity market exposure, do I stick with the winners or do I take the risk and go where it's cheap?
The issue is that in this market, which is very momentum-driven and high beta-driven, what is expensive is getting more and more expensive, very crowded, very leveraged, and we have more and more difficulties to reconcile valuation, in particular in some parts of Western markets, so US, Europe, and we find more and more value actually in Asia at large. Sorry for the previous speaker, but China is very cheap, and there are some very nice companies there which are totally overlooked, and that we start really to like a lot actually, because you pay a third of the average price of the US, and you get a nice economic prospect, a good earning momentum, nice innovation stream. And China is gaining market shares actually everywhere. So we, on a medium long-term basis, we think it would be a big mistake to not to have China in portfolios.
Interesting, because you're still maintaining a pretty defensive stance.
Yes.
And saying that this U.S. and Europe, record equity rally is gone too a bit far. But you're saying China could be that alternative now.
China, South Korea, Japan, but a little bit less so because of the big pickup in prices in the last year or so.
Okay.
India is expensive, but for a good reason. So we continue to like it, and South Asia as well. So Indonesia, Thailand. So I would say Asia at large. It's a big overweight for us. So we are more underweight. US, except small mid-cap, utilities, and some names which are cheap in US. But on average, the CAPI-weighted indexes are quite pricey.
How do you sell the idea, though? It's a good idea. How do you sell that to your clients? Because if we followed your advice, we would have lost some money.
Absolutely.
Quite a pain trade for
you. You're
you.
right. Absolutely. Absolutely. So we need to be humble first, because it's to time it's very difficult. Today, I have to say that with 90% of our clients, it's not yet something they want to hear. So they want to hear India, they want to hear Japan, South Korea. It starts, but China is still something that they don't want to go to. So
what still concerns them, you think?
It's a mixture of not understanding very well the policy at play, still some fears about real estate, and some overall fears of sanctions potentially coming. So when you are a US or UK-based investor, you don't want to be trapped there with sanctions. So there is still this narrative around saying finally the risk-reward, the tail risk is too high to take it.
Right. Which sectors do you have the highest degree of confidence on when you look at China, for example? What's the easiest sell you can make?
Yeah, so it's there are two main sectors that we like. First one is some very deep technology, so supercomputing, some biotechnology that are where China is really taking the lead. Renewable energy as well. The innovation in China is huge, and people don't really realize it in US or Europe, and the valuations are pretty decent. And then as well some very traditional sectors, like Mutai, you know, the white wine, or this kind of
We've heard of it.
Yeah. So some I would say some more classical sectors, but where China is making, when we see a pickup in consumption, in quality, and as well valuations are pretty interesting. There are also some, of course, electrical vehicles builders, some sneakers builders, makers, etc. When you go to more traditional things, you can find some very good companies actually. So.
What separates, we just had UBS on, and he was trying to look for parallels between what we saw in China back in 2015, which seems like a peak, versus something that was sustainable. What makes this look like something that is a longer term or medium term recovery now, versus maybe just a false start?
In fact, when you look at the GDP growth breakdown in China, it has changed a lot in 4 or 5 years. So China used to be driven by real estate and by cheap exports. Now it is driven by local consumption of better quality, some serious investments in technology and higher quality production, and energy transition as well. So China of today has little to do with China of 5 or 10 years ago, and that's why we believe the GDP growth is much healthier, and it's more for medium long term will produce some value for the country, but as well for shareholders. So that's why we like this new growth, and the shift has been very significant. I don't believe there is any other country in the world which has been able to shift its economy in 5 years' time like this. It's quite impressive.
In terms of what that means for, say, funds or mandates and specific strategies, because something that's come up is an EM ex-China strategy, for example, right? So because if I add China to the EM, then the returns go away. When you have it separately, then China kind of makes sense. Do you believe that makes commercial sense, and do you believe that makes investment sense?
Actually, we launched recently some emerging ex-China funds because of the demand of our clients. First, because they wanted not to have China, but then we have a few clients who wants to have this as well, to be overweight China, which is something interesting, and so to pilot and to be more agile regarding China exposure. So going forward, I think we will have more and more China as a specific allocation pillar with overweight or underweight, but totally separated from other countries. So it will live its own life, if I would say.
Last question. Last February, you told our colleagues back in Europe that global equity markets are about 20% overpriced. What's your assessment now? Where are we now?
The same.
Same?
I'm a little bit stubborn. No, I mean, when you do the math the other way around, we think, I mean, current markets in the West are incorporating a kind of blue sky scenario, or a very perfect scenario, which may happen. But it is quite likely that it will not happen exactly like this. So when we do the math the other way around, starting from earnings, company by company, it's very difficult to reconcile the price-earning ratio and the earning growth baked into the market. So that's why we are, I mean, markets are quite expensive still.
Okay, well, oh, sorry, can I just sneak in one last question?
Sure.
Cash. Everyone's still going in cash. $6 trillion in cash strategies. Are they wrong?
6 trillion is a big amount of money, but finally it's just 3 mega cap in terms of market cap. You see my point? So
now you put it that way.
so I mean, and cash is at last yielding something still. So I mean, cash is for us is now one allocation pillar amongst others. So we allocate to cash, I would say 5% of our funds.
Vincent Mortier, thank you so much for joining us. CIO at Amundi Group, joining us here in Hong Kong. We got plenty more ahead. This is Bloomberg.
Right, welcome back to the show. 3 movers to tell you about, well, 3 right now. There's a lot really moving across this greater Asia-Pacific equity market. So TSMC, you're probably wondering what the stock is doing. A lot of funds have this in their portfolios, 3.6%, which is just about the best day for the stock in about 3 weeks or so. Record high News, of course, out of the U.S., $12 billion in approvals. Rome is a stock that's actually listed in Japan going into the break right now. News and convertible bonds, one of the biggest decliners in the region right now, 6% lower. And Rio Tinto, I guess, as a representation and a snapshot of what's taking place across the big mining space. Rio's up substantially. There we go, 3.3%. Iron ore may be down to that. We're back at 105 levels here on prices of iron ore.
Yeah, continues to be that story. Commodities, obviously, when it comes to the China demand picture as well, though we still haven't seen any sort of the physical market and the property market turn.
Not yet.
But we're still getting that demand, I guess, and optimism around that, not just with iron ore, gold, oil, copper, all continuing to rally here this morning as well. We've got plenty more ahead. This is Bloomberg.
You should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case.
Former St. Louis Fed President James Bullard speaking to us earlier, and you're taking a look at this Japan market, and as we head into that lunch break, we're still seeing a decent rally. We're up about 0.5%, though it's quite moderate here this morning. Topics, though, is still seeing a bid. We're still hovering around that 151. Very close to 152. We haven't quite broke above that just yet here, but that U.S. inflation print could be that potential catalyst that we're all tracking here this morning. Yields are taking by about 1 basis point lower here on your JGB 10-year yield. Keep in mind there is a 5-year bond auction later on today as well, Dave.
Yeah, and just to add to the figure that makes, so you mentioned it's a bond auction as well. So about a few hours back, the finance minister also came in and really set the tone for the session today and maybe even tomorrow. Talking about the yen, they're watching moves with a high sense of urgency. They've said it before. They won't rely any. They've said that before. They will take a they've said it before. They're not judging FX by level. Suffice to say, they're watching this, but it hasn't got to a point where they're ready to escalate the rhetoric right now. Of course, we're still watching it ahead of the U.S. inflation print, which comes out late Wednesday. Asia's looking like this. Risk on. While yields are melting up, stocks are continuing to move up ex-China. We're better by 0.5%. Second straight day, we're looking at gains here in the region. Right, back to the China story. And you have U.S. Treasury Secretary Janet Yellen, of course, wrapping up her trip there, her visit to China by repeating her warning about overcapacity, especially in sectors including EVs and lithium batteries.
China is now simply too large for the rest of the world to absorb this enormous capacity. Actions taken by the PRC today can shift world prices. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
Well, not everyone agrees with Yellen on her concerns when it comes to China's overcapacity. Let's bring in David Fickling, our Bloomberg Opinion columnist. And he thinks her viewpoint is a, quote, protectionist disaster that could muddy the path to net zero emissions. David, please explain.
I'm slightly dreading setting myself up against Janet Yellen, but no, I mean, the point I'm making, you know, she herself, she's an eminent economist, one of the most eminent of her generation, and she made this point in an interview with the Wall Street Journal last week. She said, you know, the standard economics would say if a country can send you cheap goods, you should buy them and send them back, you know, the things that you can produce cheaply in return. That is standard economics. It's comparative advantage. It's one of the most sort of fundamental principles of trade economics for 200 years. Now, what is clearly happening at the moment is other countries other than China are concerned at the scale and efficiency of China's clean tech sector, and they fear that is a competitive threat to their own clean tech sectors. But looking at it in terms of the pure economics, is it artificially cheap, as she was saying? I think if you look at the firm level data of individual companies, you don't see the evidence of subsidies that are getting talked about. What you see is a very large and very competitive industry, and we've seen that sort of thing, you know, ever since Henry Ford was building giant car factories in Detroit a century ago.
Right. It's also worth noting, and I want to take a bit from your column today, and if you could just elaborate on this, that So when you have a U.S. Treasury Secretary head to China or engage with China, immediately, my mind goes to trade imbalances and the imbalance of the relationship. But you make a point here that the relationship between these two economies, is a lot more balanced today than it was 5, 10, 15, 20 years back, David.
Yeah, I mean, this gets lost in the debate a little bit, but the US Census Bureau every month publishes figures for the bilateral trade balance between the US and China. The annual figure last year was the lowest it's been in nominal dollar terms since 2010. And actually, if you measure it against the size of the US economy, because of course the US economy is much bigger since 2010, it's the lowest since 2002 as a share of the US economy, which is just months after China joined the World Trade Organization. This, this argument about sector imbalances, and I think essentially arguments are being made about the sort of funding structure of individual Chinese companies based on sort of inference from these large sectoral imbalances, but even the imbalances are not really there.
And I mean, just given, I'm just talking about just this whole EV transition, right? And just given how dominant China already is in a lot of the supply chains revolving renewable energy, I mean, can the U.S. actually not rely on China to achieve, as you say, those net zero goals?
I think it's very notable. You saw in that clip Janet Yellen talking about there is, vastly more capacity than demand would suggest. But if you compare, say, planned capacity against what the International Energy Agency says is going to be necessary if we want to reach net zero by 2030. In hardly any of these sectors are you actually seeing any overcapacity. I think you probably are in cars. You're certainly not seeing it in lithium-ion batteries. I don't think you're even really seeing it in solar panels, although there is huge capacity under construction with solar panels in China. The one sector that is not heavily exposed to Chinese trade is wind equipment, which is very hard to export internationally. And in wind equipment, we are drastically behind where we need to be if we need to get to net zero. So, I would go back to what Yellen said in the first place. If a country sends you stuff cheaply, you should send them a thank you note. If a country is manufacturing the capacity to get to net zero cheaply, again, you should send them a thank you note.
Oh, well, David, yes, yeah, okay. David Fickling, Bloomberg Opinion. You can check out his column, of course, on your Bloomberg terminal. It should also be on the internets. Okay, let's stay in geopolitics here. Japanese Prime Minister Fumio Kishida has arrived in the U.S. That's ahead of a meeting on Wednesday with President Biden. Now, the visit comes as the AUKUS Defense Pact floats the idea here of closer cooperation with Japan. And joining us now, in fact, to talk us through what's in store these next few days, Isabel Reynolds joins us out of Tokyo. Isabel, what is the Prime Minister hoping to achieve with the summit and the visit as a whole? Let's look at the big picture first.
Right. Well, first of all, I mean, the overarching aim of any visit by a Japanese prime minister to the U.S. is always just to emphasize that this alliance is rock solid. Japan still has its disputes with China over territory. They have been escalating even in recent days. It has concerns over North Korea, which is obviously very close by. So what it wants more than anything is to have the U.S. reiterate that this alliance is strong, that it applies to every part of the territory administered by Japan, and that includes those islands which are also claimed by China. Now, having said that, there are a number of issues on the table that they hope to bring forward in a statement, and there have been a lot of reports about bringing the two militaries closer together. About working together on, for example, on renewable energy, offshore wind power, all sorts of reports coming out about different things that they hope to work on together. Another aspect of this visit is very much going to be Kishida discreetly kind of trying to show that his friendship, the friendship of Japan, applies equally to both parties in the US, and that it's not going anywhere, even if, for example, Donald Trump were to win the election that's coming up later in the year. So while making sure that alliance is solid now, he wants to also make sure that he shows that he's open to keeping the same relationship with the next president, whoever that may be.
if all goes to plan, let's look at potential pitfalls here, Isabel.
Yes, well, I mean, the obvious elephant in the room is going to be the issue of Nippon Steel and US Steel. Both President Biden and former President Trump have come out against that deal. From what we understand from talking to our sources here in Tokyo, the basic policy is going to be to try and keep that off the table, not make a public fuss about it. So we'll have to see how that goes. Obviously, the media will be very interested in hearing what both leaders have to say about it. So it's a question of how discreet Kishida can keep that. But as part of that campaign to sort of back up the issue of Japanese investment in the US, Kishida is expected, according to media reports, to visit this Toyota factory in North Carolina and show as much as he can how beneficial Japanese investment can be in the US, how many jobs it provides, and how it is in no way a threat to have an ally investing in your industry.
Isabel, thank you. Isabel Reynolds there in Tokyo for us ahead of this trip. And the Prime Minister has, of course, the Japanese Prime Minister has arrived in the United States. Just some other stories that we're tracking along the geopolitical theme here. So we're looking first and foremost here at Israel. Senior Israeli officials say progress has been made in negotiations for a ceasefire in Gaza that would include the release of hostages and Palestinian prisoners. The defense minister says Israel has reached an appropriate point for difficult discussions on returning hostages held by Hamas. Israeli media say a meeting of the Security Cabinet has been called for Tuesday. Now, Germany is said to be forging ahead with a sweeping military overhaul costing as much as, get this, $7.6 billion. The sources say the ruling coalition wants to order hundreds of armored transport vehicles and 2 additional Navy ships. Now, it's part of Germany's push here to modernize its military following Russia's Ukraine invasion and will require approval from lawmakers over in Parliament. Right, let's wrap up geopolitics. We'll get you a glance of markets mid-morning in most parts of the region. Chinese markets looking like this, mixed to say the least. Parts of Southeast Asia as well. Singapore 0.7% to the upside, which I should say is fairly more representative of the mood out there. This risk-on tone, largely speaking, here in the region this Tuesday. Plenty more ahead. This is The China Show. Right, welcome back. You're watching The China Show. Breaking news in the last hour or so. L'Occitane share was halted, and we're now learning perhaps why. Blackstone is perhaps nearing a deal to take the company private, potentially ending its run as a 14-year stock on the Hong Kong Stock Exchange.
Yeah, for more, let's bring in our deals reporter, Manuel Belgori, with the latest. So what's behind this deal, first and foremost?
Yes, Yvonne, David, it's an interesting transaction we've been tracking down for the past few months. I think it relates to a broader theme here in Hong Kong. We've seen a lot of these global brands, along with the whole Hang Seng index kind of like, underperforming. And it's a reverse of what happened, say, 10, 20 years ago, right, when a lot of these global brands came to Hong Kong to pursue a listing here to capitalize potentially on that growing demand from China, so to speak. Now, fast forward 10, 20 years, and they've realized that perhaps doesn't make a lot of sense to be listed here, and what they're looking into is potentially, take advantage of those low valuations to take private the company, those owners, along with investment funds, and relist it somewhere else down the road. So basically, it's a growing theme that we are seeing in which some of those global brands are being taken private and potentially being relisted somewhere else.
And it's worth noting this wasn't the first time they've attempted to do this, or at least in the case of L'Occitane. So the question now becomes, can they actually pull it off this time?
Precisely. I think, David, you are making a good point. Is for take privates, there is always a certain level of complexity attached to it, which is basically price remains key, as in any transaction, potentially because any share move can derail the deal at any point in time, and we've seen that in the past. And then, of course, the shareholders have a say in all these. So I think that price discovery will be key, along with the financing, right? I mean, for any owner or any investment fund, they'll have to come together and make sure the financing is in place as well.
Are we expected to hear not just L'Occitane, but other Hong Kong listed companies that might go
that's
private?
That's a good question, Yvonne. Yeah. That's what we all want to hear, and we're chasing hard, right?
That's your job.
Exactly. I think the short answer is yes, given these things that we've been just discussing right now.
Yeah.
Long answer to that is, every single situation is different, and it will come down to kind of the circumstances of each specific company, but I think we are poised to see more of these. So yeah, let's wait for more.
All right. We look for more. All right. Manuel, thank you. Manuel Belgori there, our deals reporter, joining us with the latest on L'Occitane. There are some other big corporate stories that we're tracking for you today. Bloomberg has learned that UBS is planning a stake swap to get full ownership of its China platform. Sources say it's proposing to buy its remaining 33% stake in UBS Securities from Beijing state-owned assets management. In return, it would sell up to its entire 51% position in Credit Suisse's onshore arm. The development adds a new twist to the months-long bidding process, with Ant Group and Citadel earlier vying for the China venture. Tesla CEO Elon Musk says the shortage of chips spurred by explosive development in AI is starting to ease, but he's warning of new challenges ahead in the supply of transformers and other hardware. Musk spoke in a live discussion on his X platform with Norges Bank Investment Management CEO Nikolai Tangin.
Last year it was about a chip supply. People could not get enough NVIDIA chips particularly. This year it's starting to transition to a voltage transformer supply. If you look out a year or two, or certainly 3 years, it's just electricity availability. So those are the constraints on the hardware side.
A new IMF report is warning of the emerging risks in the private credit space, including liquidity and the strength of underlying borrowers. We spoke exclusively with Deputy Director Fabio Natalucci about the fund's concerns over this space.
The concern is one of rapid growth, right? So this is part of a trend that has been going on for decades, from public to private markets, and there are certainly benefits, including for borrowers as well as for investors, but there are also vulnerabilities and possible risk. So we highlight one that has to do with the more risky borrowers. So those are smaller firms with more leverage, for example. Risk related to the liquidity mismatch between the assets and liabilities. That means that liquidity mismatch is less of a concern in this fund because they have very long committed capital. But there's a growing size going market to retail, for example. Leverage, it's another vulnerability, it's layers of leverage in the system. So this is the point. In case of like a prolonged economic downturn, we just have no idea how the system would operate.
I will be curious about that layer of leverage that you're finding, how many exactly there are. But I'm also curious, on the very surface here, just how much of a force is private credit becoming in the economy?
So the sector is a significant source of credit at this point. So it represents about 7% of the overall credit non-financial sector, and it's about 10% of bank credit. So it's the size that is relevant now, but also how rapidly it has grown, right? This is why we decided to focus on this sector. They are an important source of credit for firms. They are also an important source of returns for investors, right? Including like institutional investors. And so that's the reason why we look into this sector.
Now, there is some language here that I'm very curious about, this idea of potential systemic risks that could be created. You don't say that it is posing one now, per se, but what future worries do you have down the road?
So I think the two main concerns here, one is the interconnectedness, right? So in this ecosystem of private credit, we have not just private credit funds and other structures like BDCs. We have insurance companies as investors, but also we have private equity, and the link between private equity and insurance company, it's a growing feature in market, as well as the role that banks play. Banks are one of the providers of credit to this sector. So is this the link between the funds, the private equity, insurance companies, and banks, in a world where we really don't have much data to use for assessing and monitoring this risk?
IMF Deputy Director Fabio Natalucci there speaking with our colleague Shonali Bosik. We got plenty more ahead. This is Bloomberg.
I stress that companies, including those in the PRC, must not provide material support for Russia's war, and that they will face significant consequences if they do.
U.S. Treasury Secretary Janet Yellen, they're wrapping up 4 days of talks in China with that warning against any moves to bolster Russia's military capacity. So let's look at some of the local media, what they're reporting about Yellen's visit in today's China brief, David. And the Global Times pushing back a bit against what it calls pressure from the West when it comes to relations with Russia. This opinion piece posted after Yellen's visit, leading with this illustration. Basically, can we bring it back, guys? I was just trying to explain. There was basically talking about the warming ties between China and Russia, which is being seen and portrayed here. Then you got Uncle Sam here with the bow and arrow, but look at that. They're actually going back and hitting him. So basically they're saying that maybe all these threats against, trying to roil this Russia and China relationship will just backfire for the U.S. That's at least what's been portrayed from the Global Times opinion piece there. And the commentary says China will pursue its own interests and will continue economic and trade cooperation with Russia despite that external pressure, Dave.
Yeah, it's interesting really when you dig deeper into these papers, and certainly it's one part of the narrative that has it been she's been there twice, right?
Yeah.
Janet Yellen last few months or so, and it certainly brings to mind also, we were having this conversation earlier on with David Fickling, right? And the veneer that this might be about economics and overcapacity, yes, that's probably or might be even true. The other point that they were making as well, and this is Hu Xijin, of course, who used to be at the Global Times, is still quite influential and relevant, also talked about the possibility here that the visit might actually be because they need something from China, in which case, of course, I think one of these things was some sort of intervention, basically asking for a favor from Chinese government, one of which might be talking about how they might need the Chinese to step back in, say, the treasury market. This is, by the way, what you're looking at your screens is part and parcel of that piece that was on the Global Times. Meanwhile, you do have financial papers talking about Chinese markets, securities journals saying that the Asian market should be viewed positively, as historically low market valuations, of course, do present themselves as an opportunity, as a point to attractive longer-term investment opportunities. And the earlier point I was making, too, on fixed income, that the market will maintain a bullish trend due to slowing global growth. It cites the head of fixed income at BlackRock CCB Wealth Management, who also, by the way, cautioned as the market faces shorter-term risks. And this brings to mind, and I'll bring it back to the Treasury part of the conversation here, China stepped back from owning treasuries quite massively, right? I was having a look at the chart. I think holdings are down from nearly 1.2 trillion, I believe, in 2018. That's down by about 400 billion. And, one of the points that people were making earlier on, that anything north of 5%, I think this was the Amundi CIO, then makes it not sustainable for the U.S. to service that debt, and they need a buyer like China for us to come back in. In any case, there we go. Why are we showing TSMC? Why not? Is my retort. Biggest gain in months. This is Bloomberg.